Welcome to Trading Nation. I'm Brian Sullivan. Joining us by phone, David Rosenberg, chief economist at Gluskin, Sheff. David, we know that there's a lot to be concerned about. We know some of the concerns that you have had. The market continues to run through them. Do you see some kind of a reckoning at some point here?
Well, I think that there probably will be, and the reckoning will be which market has the story right. Is it the stock market that is de facto pricing in double-digit earnings growth, or is it the Treasury market with the 10-year yield at 2.3% is really pricing in a completely different nominal GDP growth world? So the question ultimately is going to be which one of these markets is right, and my money historically has always been on the bond market, so it's not going to change this time around.
Yeah, I mean, it is a little surprising what's going on. I mean, they seem to either see something different or there's just a huge safe haven trade being played in addition to a risk-on trade in the stock market. How do you square the moves of both bonds and stocks?
Well, look, I think that right now the stock market is not really reacting to necessarily the facts on the ground. I know that earnings season for the most part has been pretty good. Still largely mixed, but a lot of companies are beating their estimates. There's no doubt about that. But this is still, in my opinion, what you would refer to as a Trump rally. And I think the market is still breathing in a lot of fumes that we're going to see capital repatriation, deregulation, and of course we're going to see these broad-based tax cuts. The bond market is actually reacting to the facts on the ground, and the facts on the ground are this. Year-over-year growth in nominal GDP this cycle already peaked at 4.9%. We have never before in the post-World War II period ever have seen year-over-year nominal GDP growth peak below 5%. That happened about 2 years ago, and right now the run rate on nominal GDP growth is 3.6%. So I know that a lot of people will say, well, the bond market's responding to the relentless quantitative easings overseas, but really the bond market is responding to the facts on the ground, which is that nominal GDP growth is slowing, and not just slowing, but you have the Federal Reserve tightening policy into this environment, which means nominal GDP growth is going to be slowing even more, and that's the world that the bond market sees right now.
You know, it's interesting, too, because they say, well, fiscal policies, fiscal spending are going to drive the market to new valuations. Isn't there a risk that if we do that, inflation will heat up and the Fed will just sort of throw water on any kind of a fiscal stimulus churn up that we might have?
Well, I don't know so much about the inflationary implications of what the fiscal plan is going to do. I mean, look, there's lots of assumptions as to what ultimately lives to see the light of day and whether this ultimately has to go through a reconciliation bill, which if it adds to the deficit over a 10-year time span means that we have a sunset clause. So there's all sorts of assumptions going on. But let's make the assumption that this tax bill or this tax proposal goes through. The Fed has already told everybody who's listening that they're raising rates at least another 2 more times this year, no matter what. And they've already said that if they adjust their GDP forecast, not so much inflation, but if they adjust their GDP forecast based on fiscal stimulus, they're going to raise rates even more. So this is a classic Newtonian physics, right? This is like every action has an equal and opposite reaction. And this is not the Obama fiscal package of 8 years ago when the unemployment rate was 10% and we were early in the cycle when the Fed accommodated that fiscal stimulus. The Fed's already said they're not going to accommodate this fiscal stimulus 9 years into a cycle where everything is looking late cycle. So the history has been that monetary policy in terms of the business cycle and the market cycle is far more powerful than fiscal policy. Even Ronald Reagan figured that out in the first 2 years of his term.
Really appreciate your views. As always, David Rosenberg of Gluskin, Sheff. David, a pleasure on Trading Nation. Please do not be a stranger, and we look forward to reading and hearing more from you in the future. Thank you.
Thanks much.
Thank you. All right, folks, thank you for watching Trading Nation and an opposing viewpoint there on the market's recent rally. I'm Brian Sullivan. We'll see you soon.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.